Let's talk seed valuations. How should we value our seed investment, our startup business looking for those first couple of rounds of investment? Now, the first thing to think about is that current economic conditions, we're in 2022, and market conditions are such that there's high inflation, there's probably a recession on the horizon, or there may even be a recession by the time this video goes out. But this means that investors are looking to reset valuations. 2021 saw an incredible high when it came to the valuations. We saw a massive bubble created as a result of COVID-19 and loads more investment happening as a result of the disruption caused by that pandemic. So we're seeing a reset in valuations is the first point. Now, that's nothing to be concerned about. Essentially what's happening is they're just being reset back to 2019 levels. So where we saw it pre-pandemic, we've had this little blip, this little random point in time where we see valuations skyrocket. They're now being reset back to the kind of normal market range that we were seeing pre-pandemic. We should be expecting our valuations to be in and around the 2018, 2019 levels. We shouldn't really be comparing ourselves to valuations that we saw in 2021 because that was a bubble, it overinflated, and there's lots of reasons that I might go into in another video as to why that happened. So they're being reset, so we should be expecting a lower valuation than perhaps 18 months ago, but that's not a concern for you as a seed stage founder because there's this 15% rule that you should be working to, and that works for a number of reasons. So the first reason that we should be aiming for a 15% equity stake being sold in your business, and that kind of sets your valuation. When you know how much you're raising and that you're going to sell 15% in your company, you can calculate what your valuation will be. And there's blogs on the Robot Mascot website that will explain how that formula works. Essentially, Seed Legals, our partner, has closed over $1 billion worth of deals, or £1 billion worth of deals on their platform. And when they look at the average deal size for all of those rounds, the average is in and around 15%. So the average equity that's sold in return for an investment of any size, whether that's 200k or £2 million, is 15%. So you as a founder should be focusing on 15 to 25% stake being sold in your business whenever you do a round of investment. And there's a good reason for this, and there's a good reason as to why the data always comes back that 15% is the average. And this is because investors, and particularly investment funds, where a lot of angels take their steer as to what investment funds are doing, have a target ownership stake. When they have a fund, they have a target ownership stake in every single business that they are going to invest in. So, for example, you might have a fund where you're making 20 deals for your fund. Maybe you've got £20 million as your initial investment. You've got another 20 million to follow on at a later date, but you've got 20 million for your initial investment. So you're going to make 20 investments, and the way that they calculate things, the way that they operate their fund is that they will make 20 £1 million investments with those £20 million. They're not going to make one £10 million investment and 10 £10 million investments. They're going to make 20 £1 million investments. So that's what they're looking to do. And in order to calculate, when they do all their crunching the numbers and they want to get the returns that they're looking for, they know that they need to take a target ownership of around 8 to 15%. So 8% to 15% for every £1 million check that they write. Doesn't matter what the valuation the founder thinks the business is, their focus is on getting an 8 to 15% equity stake for the £1 million check. Now that £1 million check is probably not going to be the full round. They might lead the round and they might be looking to take 40 to 75% of the round and then have it topped up by maybe some other funds or angels. So they would be taking a target ownership of 8 to 15%. By the time others are gone into that round and you've closed your round with 2 or 3 other investors, you can expect your dilution to be 15 to 25% come the end of the day. So that should be your aim, that should be your target, and then you will find yourself in the right ballpark for the current market. You will feel like it's a fair deal to investors. So you should be pitching, I would say, at around 15%, expecting to agree on something in and around 20%. If you get pushed towards 25%, really consider whether you're dealing with the right investors and whether or not they're trying to push you too high. Think about how many other rounds you've got in the future to do and how much dilution there might be. It might not be in the VC's or the investors' interest to take too much equity from you now, because you might lose your passion for it in the future if you end up over diluted. So just be careful, but aim for a 15 to 20% stake and you should be in that ballpark. Now, I know this works because that's the theory that we've been applying to our clients for the last, I don't know how many years, 4 or 5 years. And we didn't get caught up in this bubble with our clients over the last 18 months. We focused on making sure their valuations were pitched in and around, and we could support that through data, but we were pitching them in and around 15%. And that means that our clients that we were working with a few months ago are finding it perfectly okay to go and raise investment right now. They're not getting massive kickback on their valuations. We haven't allowed them to get caught up in this bubble of the last 18 months, and we're pitching at the level that we know makes sense to an investor in the way that they think. It's all about understanding the mind of that investor. So 15% equity stake is what you should be aiming for. Be happy to settle on 20%. If you do that for every round, you'll still have a lion's share by the end of your second or third round, and you'll exit the business and you'll walk away very happy indeed. So remember the 15% rule when it comes to valuations, and that will set you in good stead regardless of what the market ends up doing as a result of the economic conditions we find ourselves in right now.